It's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin, and especially through thin.
Why have you advised your wife to invest in index funds after your death?
Somebody who is not an investment professional, what is the best investment, meaning one that there would be less worry of any kind connected with? I think actually what I'm suggesting is what a very high percentage of people should do, something like that. So I think it's a policy that will get a good result and is likely to stick.
I recognize the logic of the fact that S&P algorithm is very hard to beat. In a diversified portfolio of big companies, it's all but impossible for most people.
The investor who's aware of that and cuts back on cost is greatly advantaged.
ETFs, such as VTI and VOO offered by Vanguard, provide an easy way to diversify your portfolio by investing in multiple companies at once. However, these ETFs can differ in their investment strategies. VTI allows you to invest in a wide range of publicly traded companies, while VOO is limited to investing only in the top companies listed in S&P 500. If you are new to investing, you may not understand the distinctions between VTI and VOO. This video will explain those differences in a straightforward manner. Tip: VTI invests in every publicly traded company in the US, while VOO invests in the S&P 500, which consists of the largest 500 companies in the US. What is Vanguard Total Stock Market ETF VTI? VTI, also known as Vanguard Total Stock Market ETF, is an ETF that is designed to follow the performance of the US Total Stock Market Index. This index covers nearly 4,000 companies, which is approximately all of the publicly traded companies in the US. By investing in a wide range of companies, it allows the holder to own small shares of firms with market value from less than $1 billion to over $10 billion. What is Vanguard S&P 500 ETF VOO? The Vanguard S&P 500 ETF VOO is an ETF that aims to track the performance of the S&P 500 index. The S&P 500 is considered the best single gauge of large-cap companies, approximately 500 companies at any given time. Together, these 500 companies are worth around $15.6 trillion. The S&P 500 represents less than 15% of the roughly 4,000 publicly traded companies in the US. Nevertheless, those 500 companies account for about 80% of the value of all stocks available on the market. What both VTI and VOO excel at: low fees. Both ETFs have an expense ratio of 0.03%. For example, you would pay a fee of just $3 per year on $10,000 invested in either ETF. Strong performance. Both VTI and VOO have performed well in the past. For instance, VTI has a 10-year average annual return of 12.52%, while VOO's 10-year average annual return rate is 12.92%. Good for beginners. Both ETFs are index funds, which means little work is needed from the investor. To invest in multiple companies, you only have to buy shares of the fund. There is no research to do beyond understanding the purpose of each fund. Diversification. Both VTI and VOO are well diversified, so you aren't putting all your eggs in one basket. VTI naturally provides more diversification since it invests in the entire US stock market. However, both of these ETFs invest in 11 sectors. Important differences between VTI and VOO. VTI and VOO are similar in many ways. Both invest in many different companies across different sectors, and their long-term performance is similar. But there are also key differences to keep in mind. They fund allocation differently. VTI invests your money in many more companies than VOO. Both funds are cap-weighted, which means more valuable companies make up a larger portion of each index than smaller companies. Both funds also heavily favor tech stocks. But because VTI invests in more companies, its tech allocation is slightly lower, 25.9% compared to 27.1% for VOO. Tech-heavy portfolios aren't necessarily bad, but tech stocks can be more volatile in some economic climates. For instance, tech stocks may react more negatively than the broader stock market to economic downturns. While VOO and VTI performance have been similar in the long term, VTI's lighter focus on tech could help reduce short-term volatility. 3. They have a significant price difference. VOO generally trades at a higher price than VTI, which we can attribute to VOO's higher trading volume. If you use one of the best brokerage accounts, or one of the best investment apps, and can buy fractional shares, this isn't a huge deal. But if you can only buy full shares, VTI's lower price makes it more accessible. 4. They have different performances. VTI and VOO have similar historical performances across the board, especially when we look at their 3-year, 5-year, and 10-year performance. However, there are slight differences in returns. These small differences won't be very noticeable for a beginner who has only a few $1,000s to invest. But for someone with hundreds of thousands, or even millions, to invest, the difference would be much more noticeable. Which ETF should you choose? Both VTI and VOO are excellent low-cost ETFs that can work well for beginners and experienced investors alike. They have the same 0.03% expense ratio, meaning either fund is likely to eat away at your returns, and the long-term performance for these funds has historically been similar. VTI is a better choice if diversification is your priority since it invests in nearly every publicly traded company in the US. VOO, meanwhile, invests in about 500 of the largest companies. VOO also has a slightly heavier concentration in tech stocks than VTI, which could result in more volatility.